Now I think it's a pretty good time to talk about the difference between profitability and cash flow. So we talked about they're definitely not the same thing, but they flow into each other. So I have a really good example I think you're going to like. I want you to picture in your head that your business is a car, right? It's got all the gadgets, you got your steering wheel, you got your gas pedal, your brakes. You can make your business go slow, right? You are in control of your business. And when you're in your car, profitability tells you how efficiently your engine runs, converting fuel expenses into power, which is revenue, to move forward. Cash flow, on the other hand, reflects the gas gauge, indicating how much fuel or cash you have available to keep going. Both are essential for a healthy and sustainable business journey. Let's talk about that a little bit more. What is it? Profitability measures your ability to generate a surplus after accounting for all of your expenses. It's a long-term indicator of your business's financial health and efficiency. How do we measure profitability? We measure it by net profit margin, which is reflected as a percentage of revenue remaining after all expenses are paid. And here's another example. Let's say your bakery has a revenue of $10,000 this month and spends $7,000 on ingredients, rents, and salaries. Your net profit will be $3,000, resulting in a net profit margin of 30%. You divide $3,000 by $10,000. This indicates your bakery is efficient at turning expenses into a profit. On the other hand, cash flow is the gas gauge of your business. Cash flow refers to the movement of cash in and out of your business at a specific point in time. It shows your ability to meet your short-term financial obligations like your rent, your payroll, your bills. And the way we monitor cash flow is we track it through cash flow statements, and we understand what our inflows are, where we see sales and investments, and outflows, expenses and loan payments. And back to the bakery example, we're talking about cash flow. Even with a profitable bakery, you might face a cash flow issue if your customers pay on credit. This means your income, your revenue appears good on paper, but if you don't have enough ready cash inflow to cover immediate expenses, outflow until those bills are paid, that's where you can get into trouble. So a question that people ask is, does one matter more than the other? Should I just focus on one, profitability or cash flow? The answer is no. Both matter, and both matter a lot. Here's why. You need to think about sustainability by balancing the two metrics. A business can be profitable but experience cash flow problems. So when you have cash flow for day-to-day operations, what you want to do is you want to focus to ensure you have good cash flow, you have more coming in than going out, and that you have enough gas in the tank to cover everyday expenses and avoid disruptions. Even though you can be profitable, you can run out of cash. Same thing with profitability, you want to think more long-term. So cash flow short-term, profitability long-term, and profitability fuels your engine, allowing you to reinvest in growth, improve efficiency, and weather any type of economic downturns that might come your way. So how do we strike this healthy balance that we keep hearing about? Well, what we want to do is look at two things. One, for profitability, we want to ensure that we boost our profit margin, we focus on cost reduction, we explore ways to increase sales prices, and that we expand product offerings where it makes sense. And then on the other hand, we have cash flow. What we want to do is find ways, strategies, and tactics to collect our accounts receivable faster, offer early payment discounts to incentivize quicker payments, and manage inventory levels to reduce holding costs. That's where a lot of cash can get stuck for a long time, so you gotta be really careful there.